Why did ETFs explode in the last decade, going from a niche product to dominating portfolios worldwide? How did the number of ETFs grow from about 9,149 funds at the end of 2023 to roughly 9,541 by the end of 2024, while global assets under management surged from US 11.1 trillion to US 13.8 trillion? Why are both Wall Street giants and everyday investors pouring money into ETFs right now? How could the brand new ETF innovations of 2025 change the way you invest for the better? And here's the big question. Are you missing out on one of the simplest, lowest cost ways to build long-term wealth without picking individual stocks? Stick around to find out everything this video has to offer, and don't forget to like and subscribe. It's free for you, but it helps Future Financing keep bringing you the smartest investing guides. ETFs, or exchange-traded funds, are essentially baskets of investments you can buy and sell just like a stock. But instead of putting all your eggs in one company, you're instantly diversifying across dozens, hundreds, or even thousands of holdings. Compared to mutual funds, ETFs trade in real time during market hours, usually have lower fees, and tend to be more tax efficient. In 2025, ETFs have gone far beyond just tracking the S&P 500. You can now invest in ETFs that focus on AI, renewable energy, space exploration, or even cryptocurrencies, all from the same brokerage app you use for your other investments. Let's break ETFs into a few main categories. Index ETFs. These track broad market indexes like the S&P 500, example VOO or SPY. Sector and thematic ETFs, focused on specific industries or trends, example BOTS for robotics and AI, ICLN for clean energy. Dividend ETFs, aim to pay you regular income, example SCHD, VYM. Bond ETFs for stability and income, example BND, TLT. International ETFs, exposure to global markets, example VXUS. Commodity ETFs, investing in things like gold or oil, example GLD. Crypto ETFs, new in 2024-25, these give direct exposure to Bitcoin or Ethereum without needing a crypto wallet. Each of these categories serves different investor goals, from growth to income to diversification. ETFs aren't free, and costs matter more than you think. Expense ratios may look tiny, say 0.05%, but over decades, those small percentages can cost you thousands. You also have to watch for tracking error, which is when the ETF's performance doesn't exactly match the index it's supposed to follow. Then there's liquidity and the bid-ask spread. The more liquid an ETF is, the cheaper it usually is to trade. Compounding works both ways. Fees compound against you just like returns compound for you.
The ETF world in 2025 looks nothing like it did a decade ago. We're seeing explosive growth in thematic ETFs, especially in AI, renewable energy, and cybersecurity. The US has approved spot Bitcoin and Ethereum ETFs, opening the floodgates for more crypto-related products. Zero-commission brokers now let you buy fractional shares of ETFs, making high-priced funds more accessible. Institutions, from pension funds to hedge funds, are increasingly using ETFs for low-cost, targeted exposure. And because many ETFs are listed in the US, they're attracting investors from all over the globe. One of the easiest ways to start investing is to make ETFs the core of your portfolio. The core satellite approach works well. Use a broad index ETF as your core holding. Then, add smaller satellite positions in thematic or sector ETFs you believe in. As for age-based allocation, here's the ultra-quick version. 20s to 30s, heavy on growth ETFs, light on bonds. 40s, Start adding more dividend and bond ETFs for stability. 50s and beyond, lean more into income and capital preservation. For the full deep dive on age-based allocation, including crypto, commodities, and real estate, watch our asset classes video linked in the description. ETFs are powerful tools, but they're not risk-free. One common trap is chasing past performance. Just because a sector ETF went up 50% last year doesn't mean it will again. Another mistake is overloading on niche ETFs. You might think you're diversified, but if all your ETFs are tech-heavy, you're not. Many people also ignore expense ratios. Those small numbers add up. And finally, not rebalancing can leave you overexposed to certain sectors or risk levels without realizing it. Before you buy an ETF, check the expense ratio. Lower is usually better. Look at the holdings, what companies or assets are inside. Check the assets under management. Bigger funds often have better liquidity. Review performance over multiple years, not just the last one. Use sites like ETF.com or Morningstar to dig deeper. Always check for overlap between your ETFs. Owning 3 funds that all hold Apple at 7% isn't diversification. Buying is only the first step. Plan to rebalance quarterly or annually to keep your target allocation. ETFs are generally more tax efficient than mutual funds in the US, but you still need to watch capital gains if you're selling. If an ETF changes its strategy, increases fees, or consistently underperforms, don't be afraid to replace it. We're likely to see more crypto and alt-asset ETFs, giving investors access to new markets without complexity. Climate tech and AI ETFs will keep expanding as those sectors grow. We could also see fee compression, meaning even cheaper ETFs. Bottom line, ETFs are not a fad. They're becoming the backbone of modern investing. If you found this guide useful, check out our portfolio rebalancing video to learn how to keep your investments on track year after year. And if you want the full strategy for building a diversified portfolio from scratch, watch our asset classes video. Don't forget to like, subscribe, and turn on notifications so you never miss the next future financing guide.